like the neoclassical theory of general equilibrium. Neoclassical theory is the, let's say, the dominant framework from which we approach economics. It makes several assumptions that don't hold in the real world, but pretty much every model you create of the economy has to simplify things down, or else the model isn't useful. So it's a tool to try to understand what's going on. In this case, we assume that the economy is usually in equilibrium, which typically isn't the case. We assume that there's no things like search frictions, there's no difficulty to find people to buy or sell with, so there's low transaction costs. Prices are low, or prices are known. There's very little ignorance in the economy, whether it's about like price or quality. So you draw your basic aggregate supply and demand model. So we'll do price level and output, Y, for output. Just like normal, you have supply and demand. And the economy is typically, in the neoclassical model, in equilibrium. So the curves cross the proper point. You have the equilibrium output and your equilibrium price level. Now the focus of your typical neoclassical theory is trying to understand things that shift either the aggregate supply or aggregate demand. Because here we're looking at the whole economy, not just one product or one industry. So it's trying to understand what moves the aggregate supply curve and the aggregate demand curve, and then how the market overall responds to that. Now your Austrian theory, stuff I talked about especially in my micro class last spring, is basically the theory says this is all well and good, but the really interesting part of what we're trying to understand is human action, like how people respond to changes in incentives or changes in things like aggregate supply and aggregate demand. So that's going to focus on the process by which these changes take place and what goes on when we're moving back to equilibrium. So in this case, let's say there's been a shift in aggregate demand. So we've moved from here out to here. So there's been an increase in aggregate demand. Neoclassical theory is going to look at what happens with the GDP, or the total output, what happens with the price level. And that's the area where these investigations, where the theory really focuses. Whereas the Austrian theory, which focuses more on micro than macro, they're going to try to understand what these individuals are actually doing that increases aggregate demand, how they respond to it, how businesses respond to it. Again, this is typically more of a micro level than a macro level. So for this case right here, you could say that aggregate demand has increased because the Federal Reserve has conducted open market operations to try to lower interest rates. They're trying to increase consumer demand, and you see that happening here by a certain amount. So the neoclassicals may try to estimate what the effect of that certain size market operation, what that translates to an increase in GDP. They're going to try to understand the trade-off that we get with higher inflation. Not so much investigating why these things happen, sort of, I don't want to say taking it for granted, but the focus is on moving to the new equilibrium. So now for this class, and literally starting next class when we talk about how the market operations work, in more detail, we'll be talking about like supply and demand of banking reserves. And we're not going to try to understand what individual bankers are thinking when they move to increase their reserves or decrease their reserves, when they respond to the Fed's policy. That's not really what we're trying to understand in money banking. What we're trying to understand is what is the general effect or the general outcome. So in this case, when the Fed engages in policy to try to increase aggregate demand. They try to stimulate demand, usually, or what they use. We are going to see an increase in aggregate demand, so an increase in output by whatever this difference is right there. But at the same time, we're also going to see an increase in inflation. So the price level is going to increase. As something I mentioned before about how the Federal Reserve engages in what's called inflation targeting, where they try to set a 2% goal for inflation as a yearly average. And I said a lot of people, a lot of non-monetary economists listen to the Fed saying, oh, we want to increase inflation, especially like during the financial crisis. And so we need to increase inflation 2%. People got frustrated by that because they say, hey, look, we're losing our jobs, and now you're talking about trying to increase prices for us too to make it more difficult. But one of the problems with inflation targeting is they're targeting the side effect. So in this case, what the Fed wants to do is increase output. But also at the same time, you're going to get some inflation as a side effect. Which is just something to remember when the Fed talks about their inflation target. They're trying to increase aggregate demand, and by doing that, you end up with some inflation. On the other hand, if you increase aggregate supply, and that's not something that the Federal Reserve can do, that's something that if firms become more productive, if they create new techniques, whether they innovate a product or just find a cheaper way to make the same product, you can increase aggregate supply. And moving that to the right, move it out here, comparing to the original aggregate demand curve, you now move down here instead of up here like before. So while you still increased output by the same amount, you're now decreasing the price level. Go from over here to the new price level. And that's another reason that another shortcoming of inflation targeting is it doesn't take into account the role of increasing aggregate supply in the price level. In this case, the Fed would be worried that inflation is running too low, and in fact, that's a good thing that's happening. So most of our discussions, when we look at these sorts of, whether it's aggregate demand and aggregate supply or the supply and demand of banking reserves, we're going to be focusing on the neoclassical theory and their focus on just like what the effects of moving from one equilibrium to the next. Something that the Austrians believe and talked about at length is the fact that the economy is usually in disequilibrium. That we're the supply and the demand of goods don't cross perfectly because of problems we see in the economy. Information asymmetry, where one party has less knowledge about the product than the other. Maybe something, relative scarcity's changed that increased the price, but that hasn't spread across the entire the market for that industry yet. So maybe, I don't know, say there was like a drought in the Midwest, so there's fewer grains on the market. That's going to take time to penetrate the entire world market for grains. So you're going to experience disequilibrium in this case until that change in prices move throughout the entire economy and is reflected in the new price. I just wanted to sort of give you guys this introduction. So next class, when we start with the federal funds rate, you can understand this is the focus we're doing. This is the kinds of things we're trying to understand when we're studying all this stuff using neoclassical theory. You guys have any questions about this neoclassical theory in general? Okay. Once we start, doing more examples in class, if you do, obviously don't hesitate to ask.
I have a question.
Yeah.
What's the aggregate supply curve called that goes like kind of like with an asymptote? Like starts out really shallow and then has like a
If it's
very long part.
If it's just like, say, well, I'll do it over here, like that.
Yeah, is that called anything special?
It's still an aggregate supply curve.
Okay.
It's just, usually when we do these models, if it's like general stuff like this, we'll just use straight lines because it's easiest. If you have like an aggregate supply curve shaped like that and then like a funny shaped demand curve, depending on which way you move and like where they cross, you can get big increases or small increases. For banking reserves, it's similar to this. I think it goes straight up at one point. That's just because that's how the market for banking reserves works. Yeah, I don't really think there's anything I want to say about that. Anything else I need to say right now? You guys know if the Steelers won yesterday? They what? Oh, they played tonight? Okay. Yeah, I didn't get to see anything in the airport yesterday. Well, I saw a little bit of the Bears game for some reason. They had that on. That was just an ugly game. Okay, so at this point in your projects, the early source list was due last week. So it's still pretty early in the process of putting together this research. One of the goals of this research is to actually do some testing of theory yourself. So stating a hypothesis and using data to create a model to see whether that hypothesis holds true or not. Obviously developing some theory along the way and explaining, just to explain what's going on in the model, what you think is happening. Rather than give you guys like the idealized, like what happens in the scientific method, instead I figure I'll just talk about the last paper I did to give you like the basic process that we use. And then, and if you guys have any questions about your paper specifically, we can talk about those, kind of workshop it. When I was in grad school, we had to write like a thesis for like our master's. It's obviously smaller than like a PhD dissertation. And in class, sometimes we would just like read stuff and discuss it. And then other classes, we would like come and literally talk about our papers, where we were, present on that, and then get feedback from the class, like different ideas to add to it or new interesting ways to take it. It's not the most fun thing in the world sometimes to have to stand up and talk about your paper when it's like not even done. But I found it was really helpful for both like myself, like getting ideas from other people, and then I know it was helpful for me just thinking through other people's papers. Helped give me even ideas for my own. And obviously, I was able to help them too, which is a good thing. So the last paper I wrote with Timmons that we sent to the reviewers a couple weeks ago is about a law in New Jersey that requires dialysis clinics to have a special nurse on their staff. And their whole job isn't like to take care of patients or provide any kind of medical care. It's just to do administrative work, which is odd that they have someone with medical training, years of medical training, has to get a license and keep up with a continuing education just to fill out paperwork. Would it be cheaper to hire someone just as an administrator? Especially considering we don't have a nursing shortage yet, but within like the next 2 or 3 years, we're projected to have a nursing shortage, which is only going to grow over time. Basically taking a bunch of them out of the labor supply and moving them into administrative roles seems counterproductive at best. And they're the only state in the country that has this specific regulation for dialysis clinics, which is where it's for people with kidney failure. Like they take out your blood and run it through a machine to clean it and then pump it back into you, basically doing what the kidney does, but outside the body. So in order to investigate this, we had to look at our theories. What is the impact on health outcomes of this regulation. So it seems counterproductive, but is there actually a good reason for it? Like, does having them there actually help patients get higher quality care? That's sort of the theory that was stated behind this regulation. Whether that's why they passed it or not, obviously isn't clear, but that's what they say. In the dialysis, I guess, industry, they say one of the most important things is having adequate nursing staff that are able to spend a good deal of time with the patients, because patients go there for treatment, say, I think like 3 times a week. So they build a relationship between the patient and the nursing staff. And it's just slightly different than typical healthcare. So they have some slightly different regulations. New Jersey is also one of 7 states or 8 states that has requirements for the nursing staff ratio. So, like, for instance, in New Jersey, you can only have 4 patients for every 1 staff member working at the time, in order to keep down the ratio, so that nurses are able to spend an adequate amount of time with each patient, make sure nothing's going wrong, that there's no leak in the system, or that they're cleaning the blood enough. So, in order to test this model, we gathered data on health outcomes for people on dialysis, or taking hemodialysis, whatever the proper term is. It's a little too early for me to remember that. So we looked at like their death rate, and we looked at like, I think, the infection rate in dialysis clinics. We also gathered some control variables that also came from the CDC, and some demographic characteristics, because different demographics get kidney failure at different rates. So for instance, African Americans get a much higher rate than, say, whites or Asians, Hispanics. And it hits males and females differently. I don't remember off the top of my head which one. So typically what we do in these studies of different state policies is we do what we call a natural experiment. It's basically a natural experiment, so we use a difference in differences methodology. So we compare the states that have the regulation before and after, compared to states that never passed the regulation. So we can see the jump in the states that changed, whatever that difference is, and then compare it to whatever happened in the states without the regulation, which is very similar to what we get in a real experiment, which is one of the reasons why state level policy is so cool, because it's easier to design these things, these studies. Unfortunately for us, we can't use that, because New Jersey is the only state that has this regulation. So basically the model that, because there's so few observations where this regulation takes place, the estimate is likely to be inaccurate. So we had to use a different type of statistical technique called the synthetic control, which is really cool. What you do is you take a weighted average of all the other states, and the algorithm basically combines those in a way that their characteristics match the characteristics of whoever you're studying. So in this case, we combined a certain number of states. I think ended up being 5 that we selected, whose characteristics basically matched New Jersey during the entire period before that regulation was passed. What we ended up finding was that there was no effect on outcomes from that regulation. That if you look at, say, the death rate before, there's time, there's death rate. This was the year that the regulation was passed. I think it was 2004. Before the regulation was passed, it was decreasing like that. The quality of healthcare was improving for dialysis. And for the synthetic New Jersey that we created, it was very similar. Obviously wasn't a perfect match, but it was virtually the same. After, excuse me, after this rule was implemented, we see New Jersey kind of continue to fall and level out. Likewise, we see the synthetic New Jersey that we created do pretty similar, but there was a slight decrease over New Jersey. So we ended our paper by discussing this outcome, that we really saw no effect, but there was a slight actual increase compared to our control group with after the passage of that New Jersey regulation. Something I didn't mention, those 7 states that had staffing ratios, because they're supposed to increase the quality of the treatments that patients undergo, we excluded them from our sample. So instead of comparing Jersey to the other 50 states in DC, we knocked out the 7 of those that had the requirements. So it was a slightly smaller pool, but it was more accurate to compare to New Jersey. So when we wrote this, the first thing we obviously did was look for sources about like what hemodialysis is and what the New Jersey regulation specifically were. Just trying to understand what's going on there. Then we built up some more. We found some more papers about the hemodialysis industry, like what affects quality. And that's where a lot of the conversation in our paper about staffing ratios, where that comes from. So the way we worked on this was build up first with a literature review of other studies, and there's some studies that we included that estimate the health outcomes from different regulations. So we also included them because we built upon their theory. We just applied it in a different setting. From there, we then we gave a summary of what the hemodialysis industry is like, and then a little bit of the history of where these regulations came from. From there, we developed the 2 potential theories. The one that this would have an impact because that would improve health outcomes because now staff has more time to pay attention to patients. We said it could have no effect, that having more administrative workers doesn't help health outcomes. And then we had the third that it does impact, but on the other side actually makes things, did I say make things better already? Okay, you can either make things better or make things worse if it has an effect. So we gave those 3 theories. We then described the model we used. We described what a synthetic control was, why we used that over differences. And then, like I said, explain what the synthetic control is. The less common your technique is, the more in-depth you have to explain it. There's been a dozen or so papers using synthetic controls, so you still kind of have to explain it somewhat, but not like the original papers had to go into like the algebra and the like linear algebra, that kind of stuff behind it. We don't have to do that so much, but we still have to explain why we're using it in place of other things. We went through our data, where we got it from, how we construct our data set, which isn't a very long section, but it's important to make sure your readers know where you got the stuff from so they can recreate it if they have to, or if they want to. Do some basic description of the data. Just look at simple means and medians, standard deviation. I can highlight the extreme differences between states or between groups within the study. And then from there, actually constructing the model, explaining why we dropped those 7 states from consideration in the synthetic control, and show the results, and then explain the results. So first, just saying exactly what happened, what we see from it, and how strong the model was. Synthetic control is a little bit different than a lot of your econometric techniques, so there's like no R squared to talk about. But in your model, or in your papers, we discuss the R squared, so how good does this model actually predict what we're talking about? And then from there, what are the implications of our findings? So the fact that we really see no impact to this regulation, what does that mean? It means we have poorly designed policy that's increasing costs, but it's not passing on any benefit to the consumer, to the patient. So laws like this, New Jersey should consider scrapping it, and other states should, it's evidence to show that new states should not consider passing this regulation. So while your papers are going to have like a different focus, and I haven't done a monetary paper with a good model in a while, which is why I had to go through a more micro level paper. It's going to follow the same basic strategies. And then some people like to write their introduction first to like get their thoughts organized, but I usually like to just sketch like a rough outline of that to get my thoughts organized, and then wait until the end and write the introduction. Because by then your hypothesis might change. You might discover new facts in the research process if you say you're confused by something in your model, maybe a result you found, or you saw a paper that you found a paper later that had a different control variable. So you may need to add that to your introduction later. And if you've already got it written, it can make it more difficult. The intro isn't super long and detailed, just sort of, catching people's interest with the topic, explaining what the problem is and why it should be of interest, and then a quick summary of like what you're going to do and what your findings are. Likewise, the conclusions, that's going to be like a page and a half. And your conclusion's going to be like a page, just basically stating what you found and why it's interesting. We didn't really have a chance for this, but sometimes you can run what's called a robustness check, which is a slightly different model to show that your results weren't like due to chance or due to luck in one place. So I don't know, for this, I've heard for one synthetic control paper, they kept knocking off some of the potential control states as like a robustness check. Just formulating the model in a different way to show that the results still hold when they subject themselves to different constraints. I think that was the California smoking paper. California was like the first state to really come out against smoking, and they wanted to see if their smoking bans and taxes worked, but there's no good state to compare them to, like as a control group. So they developed a synthetic control method to deal with that. And then they ran through the synthetic control a couple times, each time decreasing the sample size of potential like states to use, based off of their standard error or the what their cigarette consumption was compared to California. They're two different, knocking them off. So sometimes you can include a robustness check to help strengthen your results, to show, like I said, to show that they're not just due to random chance. The papers in academic journals basically follow like that basic strategy of your introduction, your literature review, some background on what you're studying, the theory behind the model, the data, the model itself, the results, and why it's interesting. So for your guys' papers, do you guys have any questions for that? Do you have anyone want to share what steps they've taken so far? I know it's still early, so you're probably not very far at all. Max, have you narrowed yourself down to a topic yet?
Not really. I leaned for one thing, couldn't find data on it.
All right, what thing were you leaning towards that you couldn't find data on?
I don't know. Well, it wasn't that I couldn't find data on it, I just see like there was a lot of papers already written about it. I was something with a student that, I think, a couple
Yeah.
There's so many papers on it, I was like, that's stupid.
Yeah, it's definitely a topic that would have a lot of papers. But is there an angle within that you could take that other papers haven't?
Probably. I think it's another topic.
That's true. There's one of the problems of writing now is that there's a lot of papers that have already been done. So you have to find interesting niches or interesting angles to take.
I'm hoping that the first chapter of this book sparks fire.
What's the first chapter of this one?
It's kind of like on the history of economics. It seems like it talks about like money and coinage and how seniorage was like a motivating factor of older governments.
Fiscal theory of government's role of money.
Yeah.
Okay. I might be able to spawn something. I don't know. For those of you who turned in your source lists, like I said, I'll go through those hopefully in the next week and be able to get back to you some ideas of, I guess, how good your topic is, like what the literature is like. So like in like different avenues that you can investigate within that. And then hopefully you got all the sources you need, but maybe that if there's something else, another source that you haven't come across yet that I know about, I can point you in that direction, just to help you start writing the papers.
How about this topic? I will have fiscal data on taxes and stuff.
Yeah.
It is something with how those measures affect different industries.
That's more of a general macro paper than a money and banking paper. That's fiscal policy.
Or like ties with bank. Something in
Like bank regulations.
there. Yeah, or like,
Since the Fed now is a banking regulator, I think it's fair to tie banking regulations into a paper. And it doesn't just have to be monetary policy. Like, what's the impact of monetary policy on this measure?
yeah. Like you said, it's one of the variables.
That would have to be your variable of interest if that's what you're studying.
What they always say, M equals PQ plus C.
Anyone want to just volunteer your topic? Just to say to the class what it is.
Yeah, I'm still doing that oil thing, looking at the correlation of price of oil versus macroeconomic indicators of GDP and inflation.
Have you found other research on that topic?
No.
Which can be a good thing or a bad thing? Good thing is whatever you do is new. Bad thing is you have no basis to go off of.
Groundbreaking work here.
So what's the first steps you're going to take now that you've got?
So I'm just like compiling all of the data right now. Like I have a couple of time series data for GDP and price of oil and inflation, but like they're all kind of in different sets. Like GDP is quarterly, and the price of oil I got was monthly. So I'm gonna have to like interpolate for each month based off of that.
Yeah, you can try interpolation. You can see if there's other sources that have it quarterly. Like if you go to Fred, you can go as narrow as they have it. So if they have like stock data, they have like daily, but you can get that all the way up to like annually, or like GDP, they have it quarterly, semi-annually, and annually. So some places will let you choose like how often, like how many data points you have per year. Other places don't, and that's combining data sets is one of like the annoying things, especially if like one is like if you have like a cross section, so it's like states like all 50 states for like 1 year, and then all 50 states for the next year. And the other one is like all for that first year, and then for each one state for like each year, and the next state for each year. And you've got to like sort them and then combine them in Excel.
It's fine.
I had that with crime data. Like the crime was all one way, and then like half the controls were one way, half the controls were another way. And building those data sets by hand was just miserable. All right, so it's basically the end of class. You guys have any
Any questions before we leave or any